Okay, everybody, we're going to get started. If anybody has a question at any point, please feel free to enter it into the chat. I will be monitoring them throughout the webinar. In addition to that, we encourage you to please visit our YouTube channel and subscribe so that in the event that you are not able to make one of these sessions, that you're alerted when we have a new meeting, a new session and the topic, and you're able to watch whatever the new subject of the week is that we're going to be talking about. And we have really a lot of great information. So today we're going to be talking about reverse mortgages. We're going to talk a little bit about an outline of reverse mortgages. What are they, how they work, so that everybody understands, because I think there's a lot of misconceptions about or misunderstandings about reverse mortgages. In addition to that, we're also going to talk about how to use reverse mortgages for purchases and how to help people to be able to use this as a strategy to be able to purchase a property as well, and what's different. So let's talk a little bit about what is a reverse mortgage and what exactly does it mean. So with a reverse mortgage, it literally is the opposite of a regular mortgage, which is called a forward mortgage. So a regular forward mortgage, which is the mortgages that everybody knows about or that everyone is used to seeing, is a mortgage where a borrower pays, a homeowner pays principal and interest on their mortgage every month. A reverse mortgage is the opposite. So with a reverse mortgage, the borrower does not have to pay the principal and interest each month. And in fact, the interest that they're not paying is actually added to the back end of the loan. So it has really an increase every month of the interest that has not been paid. So in the event of a regular forward mortgage, your principal is going down, or the homeowner's balance is going down every month. With a reverse mortgage, if a homeowner does not elect to make a payment, which they don't have to, but they can, a lot of people don't know that, you actually, a homeowner can make a payment with a reverse mortgage. There's nothing that prevents them from making a payment with a reverse mortgage. But if they don't, and they never make a payment ever again, then their balance will increase. So their balance will increase every single month by the interest that they have not paid. And then they're basically going to be paying interest on interest because their balance is increasing. And so eventually, over the lifetime of the loan could grow pretty substantially. So one thing to know is that there's never any prepayment penalties with a reverse mortgage. The loan could be paid off at any time. And it's very similar to a regular mortgage where you just request a payoff and then the balance is given to you in writing, and then the home can be sold or refinanced or whatever the case may be. Excuse me for 1 second. Hold on 1 second. Sorry about that. So with a reverse mortgage, it is all dependent upon the age of the homeowner. So there's a lot of other things it's dependent upon, but there isn't really the same calculations as far as debt to income ratios go with a regular mortgage. So sometimes a reverse mortgage can be really helpful if you have a senior who has very low income and they wouldn't qualify for a normal mortgage, or in some cases, maybe they have no income. Now, there are some income requirements for reverse mortgages that we'll talk about here in a second. So just keep that in mind, but it's a lot different than a forward mortgage. So just to kind of backtrack on what I was saying about the age, the typical age that a reverse mortgage starts is at age 62. Now, there are programs that go to a lower age of 55, but those are kind of like a portfolio reverse mortgage. So let's just take a step back and talk about the different types of reverse mortgages. So similar to regular forward mortgages, there is a government reverse mortgage, which is through HUD. It's actually controlled by HUD and FHA. And that's actually called a HECM. It's a home equity conversion mortgage. So that is through HUD. And then outside of the HUD or FHA guidelines, there are portfolio reverse mortgages. And those portfolio reverse mortgages basically mirror, or they're similar to, the requirements of HUD, but they may go to a lower age, or they may go to a much higher loan amount, or they may have some little nuances that are much more catered to a portfolio product. So for example, if we have a reverse mortgage with a loan limit of $726,000, whatever the new loan limit is going to be for HUD for 2024, which changes every year for reverse mortgages. If this is going to be something that exceeds that, then you would do a portfolio loan. Or if somebody is under the age of 62 and we're looking at something where we need to do a loan that's for a lower aged person, then that may be a portfolio loan. The reason why I tell you this is that the best type of reverse mortgage is usually that HUD HECM reverse mortgage, because it gives everybody the most options, which we'll go over here in a second. But let's just back up a little bit and talk about the age that I just mentioned. So typically speaking, when somebody is younger, on the younger end, more equity is required to be set aside. So let's just talk about how reverse mortgages are calculated. Reverse mortgages are basically a mortgage that says to the homeowner that they will never have to pay a mortgage payment ever again in their life. So the banks, the lenders, have a calculation that they do based on the homeowner's age that says, okay, your life expectancy is XYZ, whatever that XYZ is. They then do a calculation of interest from the starting point of today, or whatever date that the borrower is trying to start the loan, to the life expectancy age. And then they say, okay, he's going to live 30 more years and we need to collect 30 years of interest. So based on 30 years of interest and based on perhaps there's a payoff on the mortgage of their existing property, or perhaps they're purchasing a property and there's a certain purchase price and they're looking at what is the down payment that's required, they're going to achieve a maximum loan amount. So they're going to say, based on this borrower's age, this borrower is expected to live 20, 30 years, or whatever the case may be. Could, if they're younger, it could be more. Based on that, we have a maximum loan amount we're going to offer of $700,000, $800,000, $500,000, $1 million, whatever the case may be. And then we as loan officers back into that figure. So then we say, okay, based on their age, this is the maximum loan amount that they can get. Now we know they're purchasing this house for $600,000, or we know they're trying to pay off a loan for $500,000, and we back out those figures so that we're able to tell the borrower, hey, on this purchase, this is how much of a down payment you need to do a reverse purchase. Or if they're refinancing or trying to pay off debt, this is how much money that we can give you, and this is what it's based on. So it's all based on the age. Now, typically speaking, the lender is going to go off of the lower of the two homeowners. So let's say there's two people that own the house. One is age 62, one is age 65. They are going to go off of the lower of the two homeowners. Now, one other important thing to note is that there cannot be somebody younger on title. So if their kids are on title, or if the spouse is significantly younger, that may not fly with reverse mortgages. They are allowed to do it in a trust. There are things that they can do within a trust, but they can't have kids or somebody else on title that's significantly younger. That affects things pretty dramatically. So if you're a realtor and you're looking to write up a contract for a person who wants to do a reverse purchase, and the buyers say, hey, I want to add my kids or something like that, that's something that they can do later on with their will or through trust or something like that. They can't do it on the initial contract. So most of the time, as a rule of thumb, it's a pretty good guide to understand that the younger they are, the higher the down payment is if it's a purchase, or the less equity they'll be able to access if it is a refinance. The older they are, the more equity that they will have access to if it is a refinance, or the lower down payment that they will have as a purchase, if it's a purchase. Now, there's so much information to talk about, so I know I'm kind of jumping around here, but let me just go back a little bit to what I was saying in reference to the income calculations. Now, with a reverse mortgage, there's two ways to determine whether a person qualifies from an income standpoint. First of all, with a reverse mortgage, there's a calculation that is done that we have to do that determines what is the cost for the borrower to maintain the house. So we look at the square footage, and there's a certain calculation that we take for utilities and such, and we come up with a figure that this is what their estimated cost is to maintain the house. And then we take any association dues, taxes, and insurance, and we factor that in. Now, their Social Security or retirement funds or whatever the case should generally or hopefully cover this portion. However, if this is a situation where the borrower has assets, or the borrower is taking money out of the house, there is an asset depletion model where we can use that. We can show, hey, this borrower has XYZ in the bank. If we divide that by X number of years, they have sufficient funds to be able to cover these costs. So if a borrower does not receive Social Security or does not have a pension, it is not the end of the world. There are other alternative ways that we can document their income. It is not as complicated as a forward mortgage. So oftentimes you will see somebody purchasing a property using a reverse mortgage, if they're able to, if they're of the age and they're able to, just because perhaps maybe they're older and they do not have, they're not currently working and they're living off of their assets. So this is a strategy also that can be used if they want to use it. Now, let's just talk a little bit about how credit is looked at with reverse mortgages. So there is no minimum credit score with reverse mortgages, but lenders have an overlay that they put. In fact, that's pretty common for FHA. A lot of people don't realize this, but FHA loans don't have a minimum credit score. It's not like HUD sets a minimum credit score. It's that the lenders set a minimum credit score. So it's very similar with a reverse mortgage. Some lenders will go down to a 550 score. Some lenders will go have requirements that are higher. That's one of the benefits of using the Truth About Lending, is that we're licensed with over 35 different lenders, and we know, hey, on this reverse mortgage, this person has a 550 or 580 credit score, and we're now in a situation where we have to use a different type of reverse lender. Now, there's something that is called a life expectancy set aside. And the reason why that's important to know is that if somebody has some credit issues, then more than likely the lender is going to want to escrow for taxes and insurance. Now, typically on most reverse mortgages, this is not done. It is not escrowed. It is not collected. The homeowner or the buyer, if it's somebody buying a property, has to pay their taxes, their insurance, their association dues on their own, out of their own pocket, once a year, once a month, however they want to pay for it. But if somebody has a credit issue, or if they're credit challenged and we're doing a reverse mortgage, then the lender may say, hey guys, listen, we're going to go ahead and let you do this reverse mortgage. And because we're letting you do this and because there's credit issues, we want to do something called a LISA, or a life expectancy set aside. What that means is they're going to say, Mr. Smith or Mr. Jones or whoever it is that's buying this house or refinancing the house is going to expect to have $1,000 a year, $10,000 a year, $20,000 a year, whatever it is, to pay the taxes, insurance, and association dues. So they're going to require that buyer or homeowner set aside that money and either bring more money to closing if it's a purchase, or if it's a refinance, they will give them less money, or could possibly mean that they would have to bring money to closing, depending on the situation. So it's kind of basically a way the lender is going to pay their taxes, insurance, and association dues for the rest of the entire term of the reverse mortgage. Okay, so we've talked about credit, we've talked about income, we've talked about several things here so far. Let's talk about one of the biggest misconceptions on reverse mortgages. The house never goes to the bank automatically. It has to be foreclosed on, just like any other type of mortgage. When you do a reverse mortgage, you are not giving up ownership of your house. You're not giving up ownership of the property in the future. You're not doing anything with the deed of the property. You're not changing ownership at all in any way, unless you want to, unless you want to put it in a trust, or unless you want to add your spouse to it, or whatever the case may be. But that's the same on any mortgage. So there's this huge misconception that it's really a shame that there is this misconception. And I think I kind of understand how this misconception started, but basically you never are automatically giving the house the bank. Never, never, ever. At the end of the reverse mortgage, well, let's back up 1 second here. So when somebody has a reverse mortgage, whether they used it to purchase a property, and we're going to talk about those strategies here in a second, but whether they used it to purchase a property or if they're refinancing a property, they are then granted the opportunity to stay in that house for the rest of their life, no matter what. As long as they're continuing to pay their taxes and their insurance and association dues on their own, or as long as they live in the property, they haven't been moved to an assisted living facility, they haven't moved out of the property and turned it into an investment property, they haven't decided to add their daughters and now their daughter is living there and maybe it's a second home. As long as it's their primary residence and they're paying their taxes and their insurance, and of course, any association dues, they could live there for the rest of their life and never have to make a mortgage payment. So they could potentially live there till they're, I don't know, 100 years old. So let's just say, for example, you have a homeowner who purchased a property in today's market for $600,000, okay? And they put down 20, 30%, depending on their age, could be more. And they started with an initial loan amount of $400,000. And they've never paid a mortgage payment. They live there until they're 100 years old. And the balance on the loan by the time they're 100 is $800,000. Let's just throw rough figures out there. Who knows what it will be. Okay. But at that time, the homeowner passes away. Now, if the homeowner passes away and the heirs of the property, so their children or whoever it is, because if it's a spouse, they automatically are allowed to continue to stay in the property until they die. So if they purchase the property together, married, and it's two people together who are married, there is no, or they actually don't even have to be married. If there are two people on the deed, it's based on the last date of the last person passing away. So just because one of the borrowers passes away does not trigger anything. But let's, in our scenario, assume that it was just one person, they passed away, and now their children are left with a mortgage of $800,000. And at that point, let's assume two different scenarios. First of all, let's assume the property is worth $1.2 million. At that point, the children will, just like a regular forward mortgage, ask for a copy of the payoff, and they'll be able to sell the property. They'll be able to refinance the property into their names. They can do whatever they had the ability to do on a forward mortgage. Okay. So in this scenario, we're talking there's equity in the property. the children were either given the property through probate, or there was a will, or there was a trust, or somehow it's conveyed, the estate has conveyed to the children can do whatever they want to do. Nothing has changed with the deed of the property, and the payoff is requested. Okay, so as long as they get paid off, they're fine. Now, typically most reverse mortgages, once they find out that somebody has passed away, usually give anywhere from 6 months to a year for the estate to really start doing something or do something with the property. All right, now let's talk about what happens with the opposite of that. Let's say they owe $800,000 worth of interest, and at that point, the property's worth $700,000, so they're upside down. Now, this is where there are two different options. The first option is they could simply walk away, and the estate does not have any liability, and they give the property back to the bank. So in that case, where the house is upside down and the heirs are not interested in taking ownership of the property, they could just give the property back to the bank and there's no liability and the house has gone back to the bank. Okay, like it's foreclosed. That's exactly what happens. It's a foreclosure, but it's a non-recourse foreclosure where the estate and the homeowners can never, ever be come after, because this is part of what the guidelines are with reverse mortgages. Now, let's say the son or the daughter really love this house and they really want to keep the house, but the balance is upside down. The estate owes $800,000. The property is worth $700,000. If this was originally a HECM or a HUD/FHA reverse mortgage, they have a specific guideline that says that the heirs of the property can pay off the mortgage at 95% of whatever the current market value is, and the rest is forgiven. Now, a lot of people don't know that. And so there's a lot of properties that end up going back to the banks or foreclosed on, basically, and they really didn't have to be. And unfortunately, because of this lack of education out there, this is where I think the misconception is stemming from, where people think, okay, the deed of the property automatically goes to the bank and you lose your house and your kids never get your house. That's not true at all. If there's equity, you could sell it or the kids can refinance it and they benefit from the equity. If there's no equity, the kids can decide, do they want the property or not? If they don't want the property, they can let it go back to the bank. And if they do want the property, they can then pay 95% of whatever the current market value is, which it's kind of like a short sale situation where they go ahead and the bank does an appraisal, determines the value, and then they reduce the payoff to 95% of whatever that value is that they determine. Now, this is for FHA reverse mortgages. This is a guideline that is automatically written in to HUD and FHA. So remember what I was saying, that there are other FHA or HUD type of reverse mortgages that are done that are portfolio loans. Those do not necessarily have that same provision. So it's important to understand which loans have that provision and which don't, which is one of the reasons why we always try to get a homeowner, an FHA or HUD type of reverse mortgage, because it has more options at the end of the loan. Now, those portfolio loans that we were talking about, you have similar options, but it's a little bit less vague as to it's a little bit more vague, I should say, or not as clear at the end of the process. So at the end of the process, if somebody has equity, you just order the payoff and you're in the same boat that you would be with the forward mortgage. So this is on a portfolio reverse mortgage. This is a non-FHA, not a HUD or FHA reverse mortgage, okay? Same thing, you have equity, you order the payoff, and then the heirs could do whatever they want with the property. Again, nothing automatically goes back to the bank. The heirs are always in control of the property. They always have the choice. Now, if somebody is upside down on one of those portfolio loans, then there is a renegotiation that they can do with the lender, but the lender is not required to do it. So it becomes a short sale situation. And that's the difference between a portfolio reverse mortgage and an FHA reverse mortgage, which is with the FHA reverse mortgage, it is written into the documents in the beginning that the lender will accept 95% of the market value, whereas with a portfolio one, you really have to negotiate with the lender and do a short sale on a reverse mortgage. If there's not enough equity, if everything is upside down, which you never know. Now, one other thing in reference to FHA or HUD reverse mortgages, there's actually a line of credit that is written into the closing. Let's say somebody purchases property for $700,000 and at the time they are doing a reverse purchase. So they're putting down 30%, 40%, whatever the amount is that they're putting down. There is a set rate of appreciation that HUD gives the homeowner, okay? So depending upon when they close, it could be 5%, 6%, whatever that is. FHA says, hey, Mr. Homeowner, you're buying this property for $700,000, but based on our calculations, the set appreciation rate of this property means that next year the property is going to be worth $735, and then the next year the property is going to be worth $760, and then the next year the property is going to be worth $790. Whatever that set appreciation rate is set for the life of the entire mortgage and does not change. So if the market goes down or the market crashes, it doesn't matter what happens with the set appreciation rate with HUD. And why is that important? Because HUD gives the homeowner access to a line of credit. So they allow them to participate in the appreciation rate, and that line of credit grows every year based on that appreciation rate. So if somebody is purchasing a property and they're putting down 30% and using a reverse mortgage, or they're refinancing a property and they're getting access to a certain amount of cash right now, after the first year is over, the equity line will start. The equity line will be just like another equity line at any bank where they'll have a checkbook and a debit card and all of that. And the first year equity line, they may have equity that they can access of 50,000. And then the second year, they may have equity they can access of 70,000. And every year, that line of credit that they can access grows. It doesn't mean they have to use it. They can let it grow forever and never use it, or they can just use a portion of it, or they can use it, pay it down, do whatever they want. There's no requirement for them to keep using it or for them to take a certain amount. However, what's good to know is that they have access to it. And this is one of the reasons why HUD, HECM reverse mortgages, FHA reverse mortgages are a really great tool for a homeowner to be able to know that not only do they not have to make a payment, but they also have access to this line of credit if they were to have an emergency or something where they needed funds later on. Again, they don't have to use it, but all of this is determined upfront. So if a homeowner comes to us and says they want to be able to purchase a property and this is what they're putting down, or if they're trying to refinance a property and this is what they're trying to achieve, we will give them the analysis in the beginning and tell them, this is the down payment, this is what you expect for the money that you're going to need for closing, or the money that you're going to get at closing if it's a refinance. And on top of that, this is what you're going to expect as far as a line of credit you'll have access to. Now, that line of credit is only available on FHA HUD reverse mortgages. It is not available on the portfolio loans. So that is just one thing to note. Now, let's talk about using reverse mortgages for purchases. So when somebody comes to us to get pre-qualified to purchase a property with using a reverse mortgage, or why would we do this? What are the strategies to do this? Well, first of all, obviously the benefit is they don't have to make a mortgage payment. And some people really are very happy that they wouldn't have to make a payment any longer, and they would rather do a reverse purchase. Then there are some homeowners that may be seniors and have very little income. and may not qualify. They may have a huge down payment, but they may not qualify for a regular Fannie Mae conventional loan. This is an option for them as well. Then there are some homeowners that maybe have some credit issues. They may have the income, but they don't have the credit. And they're also looking to try to see if a reverse mortgage may be an option. So these are all reasons why somebody may do a reverse purchase. And then, of course, there's also some really great financial strategies in reference to doing a reverse mortgage as far as people who are looking to be able to use the cash flow for other things. I've seen that happen also as well. But what we'll do is we'll take a look at the credit. We'll go over some income questions similar to a forward mortgage, but it's a lot quicker of an answer we're able to give them. And we will take a look at their date of birth, and we'll be able to calculate things. Now, let's talk about condos with reverse mortgages. Everybody knows that condos in Florida are much more difficult than condos in other states. If you have not listened to the lunch and learn that I did about financing condos in Florida and an in-depth look at condos, I urge you to go to our YouTube channel and look at that video, because there was a lot of really great information in there. But in reference to condos with reverse mortgages, they do have to meet very similar criteria to what HUD requires. Now, if it's a portfolio condo, typically there's a little bit more flexibility. If it's a portfolio reverse mortgage, I should say, and they're purchasing or refinancing a condo, there may be a little bit more flexibility. But if it's an FHA loan and they're trying to purchase a condo, which often happens with seniors, or they're trying to refinance a condo, there are the requirements for the condo to be approved by HUD. And for those who are not familiar with all of the hoops that we have to go through with HUD, one of the biggest problems is that HUD will not approve a condo if a buyer or a tenant has to go through a screening process. And it pretty much eliminates almost every single condo in Florida, or a good amount of condos. And unfortunately, it ends up eliminating a lot of options for homeowners who are looking to do this with condos. It's really sad. It's something I think HUD should change. And I'm hoping that some of our trade groups and our advocacy groups continue to try to make changes there with HUD, because on one level, we want to make sure that the condos are financially sound. And if you eliminate the screening process of the buyer or a tenant to be able to afford to live in there, then what are we doing to the financial soundness of the condo? So it's kind of a double sword there that I think HUD needs to change. Okay, so we've gone through a lot of information on reverse mortgages. We've talked a little bit about strategies in reference to purchasing properties with reverse mortgages. And I think we've covered a lot of information here. Again, just as a reminder, you can reach any of our loan officers at our 800 number. If there's anything that we can assist you with, you or your clients, please feel free to give us a call. If you have any questions, please enter them in the chat. Let's see if we have any questions here in the chat that I can answer. Right. So we have a question here. Can a foreign national do a reverse mortgage? No, unfortunately, there are not reverse mortgages for foreign nationals right now. There are a lot of other options for forward mortgages. That's a good question. Let's see, can somebody elect to take their taxes? So one of the questions is, can somebody elect to pay their taxes and their insurance in the mortgage and have the lender pay their taxes and their insurance, so they don't have to worry about that? Normally, life expectancy set aside is only for people who have credit issues. Most people do not elect to have the lender hold 20 or 30-year projections of taxes and insurance. So normally that's not the case. And of course, we would not suggest that if that is not something that is required by the lender. How long does it take for a reverse mortgage to close? Typically takes about 30 days from start to finish, just like a regular loan. There's some education courses that the senior has to do over the phone. Appraisals are pretty much the same, similar to regular forward mortgages. Okay, closing costs. There's a question here. Are closing costs different? That's a really good question. Closing costs are different because it's based, a lot of the costs, like the doc stamps on the mortgage, the intangible tax, the title insurance, is based on the value, not the loan amount. It's based on the value. So closing costs are higher with a reverse mortgage. If it's a reverse purchase, a seller can pay up to 6% of the sales price towards closing costs if you're able to negotiate that. And I think that is all. Those are all the questions. Okay, guys, this has been a session talking about reverse mortgages. And please subscribe to our channel to get our weekly updates on our sessions that we go over. Next session, we're going to be talking about the pre-qualification process and getting ready for 2024. Many buyers are re-entering the market, especially with the rates starting to head lower. And we appreciate you taking the time to watch our video. And as always, we're here if anybody ever has any questions on mortgages. And thank you so much. Have a great day, everybody. Thank you for joining us.